Today on Money Life, one of the greatest fund managers of all time has a message directly for you.
No one listening to this program should ever feel a need to own an inferior index just for diversification purposes. The S&P 500, 32% of revenues and earnings today come from non-U.S. sources. You do not need to buy an inferior index just to somehow justify to yourself or your advisor that you should own international stocks. What is going on this year is an anomaly.
That's David Giroux, manager of the T. Rowe Price Capital Appreciation Fund, 3-time Morningstar Manager of the Year, including for 2025. The longest streak of being above average in his peer group of any manager going today, and outspoken in many ways, not the least of which is that nothing that's happened this year where international investments have done great should convince you that you want to invest there. He also says that Tesla should be out of the Mag 7 and talks about how today's fund industry makes it hard for any manager to do what he does. And also talks about how it's almost impossible to achieve superior long-term results if your time frame isn't long-term. But before we get to him, Natalia Brown, Chief Consumer Affairs and Creditor Relations Officer at National Debt Relief, is here talking about their study, which showed that 6 in 10 American parents are going into debt for their children. We'll talk about what kind of debt and why they're making those choices. Plus, David Traynor, founder and president at New Constructs, is here, and he's putting a stock back in the danger for the second time before it even gets out of the box.
At my signal, unleash hell.
Well, if you like living the money life, we might be unleashing heaven. This is a heavenly program when you get David Giroux on the show. But yeah, if you want to go hard at it, we are going to go hard today. David Giroux is not shy, and we will have a great big interview with him today. At least I think it's great. I really do want to know what you think about it. Chuck at MoneyLifeShow.com. I will say now, as I will say again later, David Giroux is the manager of one of my largest holdings. So I have distinctly come to appreciate his abilities, but he is somebody who, as an active manager, you will hear, if you don't believe in active management, listen to that interview and ask yourself if maybe you wouldn't be okay with some active management, right? But then it's finding the right kind, and he makes a case for what is and is not the right kind. And it's not just about him, it's about the freedom that he's been given, that being the important thing. But David Traynor is back. He's talking about an IPO that is coming, that was supposed to come out earlier this year, and it got derailed back then, and it was dangerous when it was going to come out right around Liberation Day, and he thinks it may be more dangerous now. And as you hear this, I am down in North Carolina, having gone down to meet my new grandson. So it's kind of appropriate that we're doing the interview with 6 in 10 American parents going into debt for their children. I'm hopeful that we can help Whitney and Greg avoid that fate, although there are different types of debt. Like, it's one thing if you say, I'm going into debt so that my kid can have a better cell phone. That is very different than I'm going into debt to help my child pay for college. But in all conditions, you should be thinking about what it is that you're doing and what's right for your family. And yes, I am traveling, so everything that you are hearing on today's show was recorded before I left on Saturday morning. The same will apply to tomorrow's show. Wednesday, however, well, most of the show is done, but I figured you might want to know what I think about the little guy. Also, I'm heading on Tuesday from North Carolina directly to FinCon in Portland, Oregon. And we may add an interview there, but then we'll do Thursday, Friday, and Monday shows completely from FinCon. So we'll get some interviews there. Joe Saul-Sehy from Stacking Benjamins, Paula Pant from Afford Anything, my friend Lynette Calfani-Cox and I are planning to talk, but also a bunch of people that you've never heard of and don't know, running interesting financial blogs. We'll talk a little bit with some fintech people. It's a wild mix, and we're going to keep it fairly straightforward. I'm going to be doing a bunch of work that Money Life needs to have done. I may do a few less interviews this year. And that's okay because, man, when we get back, I'll tell you about this later on. The lineup we're going to have next week after we're done with FinCon, spectacular. I'm Chuck Jaffe, financial columnist and your host here. Money Life is independent personal finance talk. I don't think you can find the mix of guests we have, giving them the time that we've got, and hopefully the good questions anywhere else. But if you are finding it someplace else, I'd love to know what you think is worth us trying to do better, who we can emulate, who we can learn from, what guests we should have on, and more. Chuck at moneylifeshow.com is how you reach me. Right now, you've come to the right place for the talk, so let's get the talk started. Again, Natalia Brown, David Trainer, David Giroux. It's a great day to be living the money life, and you'll know that for sure when the talk starts next.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Now Money Life looks at what the survey said. Yes, this is the survey said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today we are looking at parents who are going into debt for their children. It is a survey out from National Debt Relief that takes a look at parents, and frankly, they're doing it willingly, but they did this survey in partnership with Talker Research, looking at the financial pressures parents of children ages 0 to 18 are facing, and not a big surprise, rising living costs and the rest. Here to discuss it, Natalia Brown. She is Chief Consumer Affairs and Creditor Relations Officer for National Debt Relief. National Debt Relief is online at nationaldebtrelief.com. If you want to go directly to the information in the survey, find the long link that we've got in our show notes or on our guest page for Natalia Brown. Now, Brown, welcome to Money Life.
Thank you for having me.
I don't think anybody is surprised parents are going into debt, but let's help kind of quantify the issues here because, I overspent on back to school and I've got 2 months of credit card bills that I wasn't expecting. And I'm paying off their college loans and I'm impairing my retirement because, oh, by the way, I also bought them everything in the middle. So help us understand just how far are parents going and how willing are they to make those steps?
Well, we got a lot of information. It was really, really interesting to see. We surveyed 2,000 parents, single moms, single dads, a myriad of different combinations of parents with the children from 0 to 18. And we found out that debt is just the reality of being a parent. 6 out of 10 parents are going into debt to take care of their children. They're putting, their needs on the background. If they're in a relationship, those relationships are taking a toll. There's rising costs in just medical care for children as well. So we looked at all of those factors. We asked a bunch of questions, and we got a lot of important and sometimes surprising data around how people are dealing with that debt and raising their children at the same time.
How much are these parents, when they're going into debt for their kids, foregoing their future? Let's start there, because I know plenty of people who are saying, well, I'm trying to take care of my kids, but I'm also trying to save for retirement. What percentage of parents are going, yeah, while my kids are here, I'm not saving for retirement?
A lot of them, actually. So 81% of the parents that we surveyed were prioritizing their kids' needs over their own, meaning retirement, their own healthcare, their own medicines. Some of them, and I've heard stories from some of our parents where they may, feed their children and kind of take the scraps just to maintain some balance. So an overwhelming majority of parents are not saving. There's no emergency savings. They're worried about just medical savings if their child gets hurt. There's a number around 1,500 for an emergency when it comes to a medical emergency with a child per year, and most people have more than one child. In our survey, I believe about half of them had more than one child as well. So those costs are double. Some of our parents are carrying more than $14,000 in debt, and their income is usually below the national average as well. So you're looking at a big portion of their responsibilities are either going towards trying to figure out how to pay their debt versus taking care of their children. So retirement, not a part of the conversation right now.
The flip side of that, did we ask how many of them think their kids will help them out in retirement?
Oh, that's a great question. No, I don't think that we did. I'll have to go back into our survey and see if that's something we can get an anecdotal quote on. But we did ask them about college, though. We did ask them if they were going to be prepared to pay for college, and half of the clients that we surveyed actually said that they would not be able to, or were worried about it. They were worried about their children having to take out student loans, and because they won't be able to provide for them, they're not able to save for them right now.
But the flip side of that, and I know plenty of people who have been in that place, and I know others in the financial independence, retire early movement. There are plenty of folks in the fire movement who basically say, I'm not going to pay for college, whether I can afford it or not, because I'm busy trying to retire early. How much are they also communicating this with the kids? Because you hear, I'm going into debt for my kids, and you think, I'm going into debt for my kids, and I'm trying to remove the burden from them. But as you undoubtedly know and see all the time in your day job when you're working with people, you know, if they don't plan, if they don't prepare, it makes things that much worse. So a kid who knows, hey, I'm going to be on my own for college can make decisions about I'm going to go into the military or what scholarships can I earn, and they can be thinking about that early. So how much are the folks who are going into debt for their kids sharing this information with their kids and making sure that their kids can learn the lessons and hopefully get out of this cycle?
I love that question because I always preach we should be having conversations with our kids around money and how to save and what their futures are going to look like and how they can contribute to them. The reality is that parents really in general are not having those conversations. A lot of them are trying to keep up appearances. So in our survey we found that a bunch of parents are using buy now pay later and programs for back to school and for holidays. That's really an indicator that we're still trying to provide, we're still trying to keep up appearances. We still want children to, have that wonderful Christmas morning when they open up their gifts. We're relying on debt, at least in the survey, they're relying on debt to get those to have those things happen, which means that we're not having the conversations. We're not setting the right expectations with the childrens in those households with children in that household. When you are keeping up appearances, you're setting the wrong expectations overall. So I think it was around 65% of them were relying on buy now, pay later for back to school, and 75% of the parents that we surveyed were relying on buy now, pay later for holiday spending. So that's a lot of conversations that are just not being had.
The other side of this is what they're not spending on, as you said, is themselves, but that is also taking a toll. I mean, we know financial issues are one of the root causes for the high divorce problems that we've got in this country, the high divorce rate we've got. How much are their other relationships suffering? And how much is their resentment also growing from an emotional standpoint? Because I'm doing this for my kids, but the kids, especially if they're not being taught the lessons, aren't necessarily all that appreciative.
Yeah, that's another great point. Of the parents that we surveyed, half of them actually said that there was a toll on their mental health. And when there's a toll on mental health, there's an increase in stress. We have another survey out there that talks about how stress impacts the body. And we found that people were losing about 200 hours of sleep per year just around the stress around debt itself. Forget all the other stressors that we have in our lives, just debt itself was attributed to loss of sleep, which contributes to a breakdown in relationships, a breakdown not just in divorces, but even in the relationships that you have you with your friends, your family, and your children, when you're not prioritizing your mental health. So 48% said they worry about debt more than being a good parent. In some situations, they're just extremely stressed about rising health costs, just taking your kids to the doctor, having to take that day off to, sacrifice. Maybe if you're an hourly employee, maybe you don't get paid for that. So there's just a lot of factors going into just the disruption and trying to have a fulfilling life where debt and cost and raising children and forget just trying to make sure that you're creating good little human beings. There's a cost to just taking care of them.
There's more that I'd like to explore in those costs, but we've come to the end of our time. But it is really interesting information. I am glad that we got a chance to chat with it. Nat Brown, thanks so much for joining me on the show to talk about it.
Of course. Thank you for having me.
That's Natalia Brown. She is Chief Consumer Affairs and Creditor Relations Officer for National Debt Relief. which did this survey looking at parents. Again, you can find out more information at nationaldebtrelief.com, not just about the survey, but if you need debt relief yourself. And I'll tell you what, when it comes to relief, well, we're going to take just a little bit of relief. Look, we'll be gone for 15 seconds, and then Money Life will continue right after this message.
Asset managers, you know how hard it is to stand out in this crowded space. VettaFi is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, VettaFi can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at VettaFi.com.
Belly up to the bar. You've just entered the baddest biker bar in the investment world. We're going to drink deeply. This is the Danger Zone. Welcome to the Danger Zone on Money Life. It's where we dig into stocks with the help of the experts at New Constructs, where they evaluate securities on a scale of most attractive to most dangerous. They do it by bringing together discounted cash flow analysis and forensic accounting. They dig in at the footnotes level and work their way up. And if they find that something is misleading, well, it could be working in your favor. That would make something attractive. That means we're probably not talking about it here because we're looking at the other side where things get ugly. If you want to find out more about how it works, go to newconstructs.com. David Traynor is founder and president at New Constructs. David, welcome back to Money Life.
It is good to be with you, Chuck. Thank you.
Who's in the danger zone this week?
Klarna.
Danger.
Klarna. It's ticker symbol KLAR, or it will be whenever it comes out. This has actually been a danger zone pick before when it was trying to get out of the box. It didn't get out of the box. It's still in the box. It's still trying to get out of the box, and it's still dangerous. So what is going on that makes Klarna like the only one that's been an IPO danger zone pick twice as an IPO?
Yeah, well, they didn't make it out of the box, as you pointed out. And it's, look, this is a bad business model. This is going to go down as one of our better calls. I'm pretty confident about this because the buy now, pay later industry, like I think we've joked before, like the layaway stuff at Kmart back in the day, that didn't really work. Like we have ways for people to get credit, more ways for people to get credit. There's no moat. There's no profit. This business has never been profitable in the history of our model and the financials that we've looked at, yet the valuation implies wild improvements in profitability and growth. And they've got competition that we think prevents it from ever becoming profitable as well. It just doesn't work. A bunch of other red flags too, like weak internal controls, which is one of the worst.
You know, anytime I hear about the buy now, pay later industry, I go immediately to this.
I'd gladly pay you Tuesday for a hamburger today.
Right? That's Wimpy from the Popeye commercials, and somehow he's never paying Tuesday for the hamburger today. That's the problem. You know, that's what you're seeing here with Klarna. Why haven't they been able to get out of the box? I mean, how much of this, I don't necessarily want to give you more credit than is due, but you are not the only one who rang the bell on this. Was it that everybody looked at the IPO at first and said, yeah, this is a bad idea? And why would they think they can do it this time if they couldn't get it launched the first time?
Yeah, well, I mean, it's a better environment. You know, they were trying to IPO right before Liberation Day. So that, I think, put a damper on some things for them and for a lot of people. No big surprise. But I also feel like, I mean, this is sort of kind of just capitalizing on some positive market sentiment. I think they're, look, everything's kind of positive in the market these days. I mean, I think we got gold, we got stocks, we've got Bitcoin all at all-time highs. I mean, most assets are at all-time highs. And so this is one of those, I think, that the bankers are trying to sneak in, draft behind an exuberantly, probably overly exuberant, irrationally exuberant market and just make themselves a bunch of money at the expense of individual investors. And that's just something we hope to try to stop.
You would think this would be a good time for Klarna because although they failed to come out right before Liberation Day, the addition of tariffs that raise prices, that have consumers as we head into the holiday season going, okay, maybe I got to do something else to be able to make things affordable. Well, buy now, pay later is one of the things that make people think they can afford more than maybe they can. So the conditions should be good, but there's a lot of competition. And oh, by the way, the competition doesn't have a great history either, because Affirm has been a danger zone pick in the past. It's one of their biggest competitors. So is the problem just Klarna, or is the problem, as you sort of hinted, buy now, pay later, not a great standalone business model?
I think it's a terrible standalone business model. We call it the pure play buy now, pay later. The real problem is when you're competing with firms for which your service is almost a free byproduct. And by that, I'm talking about PayPal, which, by the way, is more than 10 times larger than Klarna and Affirm combined. So they got scale. They've also got other ways that they make money. There are more profitable businesses that PayPal's involved in. And then, Kyle did some research too, and JP Morgan, Capital One, American Express, they also compete. They also are able to provide a buy now, pay later product that's not that dissimilar to what the Affirms and Klarnas are providing. And those businesses we know to be, some of them to be spectacularly profitable. So it's just, they're picking a fight they can't win. They're in a business to begin with. They have a business model that I think is just a poor business model. And they're not profitable. And the valuation is ridiculous.
Well, help us explain the valuation, because obviously with an IPO, we don't know exactly what they're going to launch at. But what do you think they should be launching at? If, of course, they're insisting on coming forward, you can't tell me zero, can you?
I mean, I don't think they should go out at all. I mean, the economic book value is negative $4 a share, right? They've got negative profit margins. They don't think they've ever had a positive profit margin. But to justify the target valuation, which is 13 to 14 billion, so we'll call it 13.5, they've got to improve their margin from negative 1% to positive 9%, which is close to where Block or Square is, and grow revenue at 24% compounded annually through 2032, which is above the industry projected growth rate. That's what they got to do to justify the current stock price.
We use the phrase standalone in terms of the business model. If it can't survive as a standalone, but you're talking about the PayPals of the world who have this as part of a line of businesses, well, that would suggest that either they're doing this for stupid money risk, the chance that somebody else buys it, or that they believe this is a way to get someone else to buy them out and get their money out as the officers of the company. In other words, take it public, assuming someone else will wind up taking them out. So is there stupid money risk here?
Yeah, it's hard to see stupid money risk here, Chuck, because of all of the bigger firms that we talked about already having a buy now, pay later capability, right? In terms of JP Morgan, Capital One, American Express, PayPal, MasterCard, Visa, Synchrony. I mean, I see those firms already as competitors and having similar capabilities, right? I mean, really all we're talking about doing is, we already have a credit card that gives you a buy now, pay later capability in essence, right? And we're inserting another buy now capability in front of that. And I don't know if there's much of a reason why some of these bigger firms couldn't, if they wanted to, vertically integrate into what Affirm and Klarna are doing. And I would submit that they don't want to, Chuck, or they could have, right? These are all profitable, extremely well-resourced firms. Could have done it, didn't do it. Why? Because there's no value. And I don't think they would pay any money to buy one of these other firms either. A great example, I think, is the deal that Affirm did with Walmart, a year or so ago, maybe at the beginning of this year. Big announcement. They thought, oh yeah, they got Walmart. That's great. Well, what, because Walmart could do it too. Why does Walmart not want to do it? There's no reason. There's no expense. There's no benefit. I'm sorry. And we look at the margins, the profitability for Klarna this year got worse. The Walmart deal was not accretive to profits. It was a headline. It was a press release. It's not making them money.
So what we're really saying is there won't be stupid money. There might be somebody who winds up being smart money and saying, hey, if this stock craters, as much as David Traynor believes it's going to, I can pick it up for a song and maybe it'll be cheaper if I want to do this myself. Like then if I want to get this in, but there's not any incentive here for anybody to buy it, at least until it's been put through the ringer.
Yeah, 1000%. How many times have we seen, how many times does our individual investor audience have to see these IPOs sort of irrationally skyrocket just to fall right back to earth? And look, if you want to play that game, be my guest. It's risky. I wouldn't obviously recommend it. But even if this thing does do well at the outset, I would imagine it's going to follow trace the path of Affirm, which saw a big rise in the beginning only to just get crushed not too much later.
Well, we'll see whether or not Klarna can actually achieve liftoff. It's IPO now or IPO later. It's not buy now, pay later. It hasn't been able to do it. We'll see if they get it off this time. Klarna, KLAR, still pre-IPO after a long time, back in the danger zone. David, great stuff. Thanks as always for joining us.
My pleasure, Chuck. Good to be with you.
David Traynor is founder and president at New Constructs. Go to newconstructs.com to learn about all they do, find the most attractive and most dangerous lists, find their danger zone picks, and more. And up next on Money Life, David Giroux from T. Rowe Price Capital Appreciation. If there's a manager with a better track record, I don't actually think I know who he is. He's one of the best you will ever find out about, and you will find out what he's thinking when we come back in just a moment. This is Money Life.
Oh, wow. This is actually pretty dangerous.
Welcome back to Money Life, where it's time for the big interview on the September 8th show, and they don't really get any bigger than this, because my guest is David Giroux. He is Chief Investment Officer at T. Rowe Price Investment Management. He is the manager of T. Rowe Price Capital Appreciation. PRWCX is the mutual fund shares. TCAF is the ETF. I will disclose, I'm a big fan because the T. Rowe Price Capital Appreciation Fund is one of my top investment holdings and has been for a very long time. During that time, well, I could say he achieved it, but I've watched him achieve it. David has 3 times been Morningstar's Outstanding Portfolio Manager of the Year for the allocation category, including this year. So he's 2025 Morningstar Outstanding Portfolio Manager for the allocation category. But he also won in 2012 and 2017. He has the longest streak of outperforming his peers in any Morningstar category. He's done it for 17 straight years. There's not another fund that has done that. And I will just point out that at one point I asked something in the realm of that streak, et cetera. And David's answer was he basically considers it, with his methodology, something that would never happen, that he would not outperform, that's part of what he's there for. So if you want to check out the firm and the fund, troweprice.com. David Giroux, welcome back to Money Life.
Thank you, and thank you for that very kind introduction. I appreciate that.
Well, you've earned the introduction, and you've done it with a fund that, I mean, it's a monster fund. Just the mutual fund side, you're controlling like $70 billion, and the ETF has exploded. In fact, it was the ETF of the week on my show from Todd Rosenbluth at VettaFi recently, because of active management. But that you're the Morningstar Manager of the Year this year because of a call you made, which has taken you much more to bonds. You are known for being something of a contrarian, but your fund, the last time I checked, was like 35% in fixed income. Not what people are necessarily expecting from a capital appreciation fund, and a distinct call on the market. So tell us, what is it that you see happening, and why have you gone so hard to fixed income?
If you think about the last, I don't know, really since the end of the financial crisis, we've been in kind of an environment where the yields you were getting on traditional fixed income investments were incredibly low. For most of the 2010s, interest rates were, let's call it, in a range of around 2 to 3%. And that was not very attractive relative to the returns of equities. You were basically had an environment where your real yield over inflation was minuscule, sometimes negative, right? We now have an environment where interest rates have got up all the way last year to the 10-year got to 5%. You were getting real yields above inflation at 2 or 2.5%, more in line with history. And I think we said that, that is a much more attractive environment for fixed income. And so we did, you're right, back in 2021, when rates were low, we only had about 17 or 18% of the portfolio in fixed income, had a lot of cash at the time. And today we're, I think, like 32 or 33% kind of traditional fixed income investments. And as obviously as rates have went up a lot and now started to come down a lot, that's actually been a nice positive benefit for our performance. And it also is a reflection of the fact the equity market is just very, very expensive. Even beyond the Mag 7, you look at the rest of the market, you take out the Mag 7, take out a lot of other companies that are kind of secularly challenged. Banks are trading at 15 times earnings. Costco is trading at 47 times earnings. Walmart's trading at 35 times earnings. There are other parts of the market that are very, very expensive that have nothing to do with the Mag 7. And so from a risk reward perspective, fixed income looks attractive. And again, going into fixed income a little bit heavier recently has actually been has worked out well. This Friday is a day where we are seeing actually rates come in a little bit, which is helping our fixed income investments today.
Back in 2021, when you were 17 to 20% in fixed income, and you said you had a lot of cash at that point, the market had come off of the post-COVID time, had rallied. You would basically were doing some profit taking, getting to cash and waiting for things to be better valued again. Are you expecting better values now? I mean, do we have to go through something so that you're going to put the cash to work again?
Actually, the cash levels today are actually quite low. The cash levels today in our strategy are about 3%. Again, back then, we had probably double digits of cash. Because if you think of 2021, that was a really strange environment. Coming out of COVID, you had a lot of there's a big tech rally in 2021. Valuations got high. So you were getting very unattractive levels in equities. There weren't a lot of great equities, as well as you had an environment where rates were really low, artificially low in 2021. So equities were expensive and fixed income was unattractive. Today, you have an environment where equities are also very expensive, but also fixed income is a little bit more attractive, especially on the shorter end of the curve. Let's call it those 3 to 5 year treasuries, 3 to 5 year investments, as opposed to kind of let's call longer dated treasuries where you have more risk around excessive deficits and that could cause some issues with some of the longer treasuries that are less anchored to this front end of the curve.
What you're saying is those days it was about not being able to get anything out of fixed income, so it was cash and wait. These days it's an investment choice. This is a distinctive, I want to be more in fixed income, and your portfolio is running, if you total up everything, about 60-40. Have you ever had more fixed income than you do now?
I think we peaked out at 35%. That was a time where the 10-year got to 5%. We thought that was kind of crazy at the time. And so we the 10-year is down. I don't know exactly where we are right this second, but we're down close to 90 basis points from that peak. What you'll typically find us doing is when you get to an extreme, like a 5-year, 10-year treasury, you'll see us go, to an extreme level of fixed income exposure at 35%. Today, with the 10-year at 4.10, the 5-year at 3.6, you're going to be more in the lower 30s, fixed income exposure today. It is an environment for equities that the equity market is expensive, and that expensiveness is not necessarily purely a Mag 7. Clearly, a Tesla's way overvalued. Clearly, a Palantir is way overvalued. But it's beyond that. It's actually other areas of the market you'd look at and say, why is JP Morgan at 15 times? Why is Goldman Sachs at 2 times tangible book value? Why is Walmart at 35 times earnings for basically a company that's going to grow earnings 5% this year? Why is Costco, basically a 10% EPS grower at 47 times earnings? So it's not simply the Mag 7 being overvalued. It's actually the rest of the market being a little bit overvalued. And there are pockets, I'm sure we'll talk about later, there's pockets of the market that are attractive. But obviously the market in general in equities is pretty expensive today.
Let's talk about just how expensive and what has to happen as you plan your next move, because you're very much helped out by the fact that you were buying when the Treasury was at 5%, but the Treasury's not at 5%. Rate cuts, I assume you think are coming, but let us know what you think about the rate cut environment. And what does that have you thinking you will do next?
Anytime any asset class goes from being way undervalued, like fixed income, in, I don't know, September, August of last year, where you're at 5%. And, so we'll have a maximum position there when it's really undervalued. And then when that asset class goes to be more fair value, which I think we're getting kind of close to fair value on treasuries, that exposure will come down. And so you could see an environment, if rates keep coming down, if the Fed starts cutting rates, you would see us probably continue to take our fixed income exposure lower and maybe build up cash like we have. We always go where we see value, right? There was no value in fixed income at the end of 21, so it had a very, very low exposure to fixed income. Most of that fixed income was in bank debt at the time. That bank debt is a variable rate of interest that you get. So if you had an environment where rates kept coming down, you would see us lower our fixed income exposure, probably increase our cash exposure. If equities, were to roll over 15%, you would see us take our equity exposure. In April of this year, when the equity market fell 19%, peak to trough, we put $4 billion to work in equities. We thought all the consternation around the Trump tariffs was misplaced. And that turned out to be a good decision for us, putting $4 billion to work really in 3 trading days to take our equity exposure from the mid 50s to kind of the low to mid 60s. So we always go where there's value in the marketplace, and we're not really scared or concerned what the market thinks. We can think independently of the market because we have a longer term horizon than the market. I think that's really our secret sauce.
It is, but you also have the leeway to do it. There are a lot of places, David, where managers can't do this anymore. And it was an unintended consequence of the rise of Morningstar, where they tried to create style boxes to be descriptive, but they turned out to be restrictive. In other words, and I bet you've had some of your clients who, if they're money managers investing with you, are like, but wait, I didn't buy your fund. I didn't invest with you to have you go this much into fixed income. Do you have that? I mean, the luxury of having the ability to go anywhere, it's what used to define star managers. It's why there are very few left. Obviously, that's a big part of the secret sauce too, isn't it?
I think that's true. I think that's very, very true. We have never gotten negative feedback from clients about our ability to go where we see value. Because if you think about the last 19 years since we've been managing the strategy, we've been doing this every cycle, right? This is not a new phenomenon. In 2009, we were 80% equities at the bottom of the market, right? And that really helped performance in 2009. During COVID, we went from that horrible month of end of February to March, we went from a mid-50s equity exposure to a low 70s equity exposure in a month. We put $9 billion to work in equities when everybody else was selling. I think everybody knows we've created a lot of value over time through, I'd call, intelligent asset allocation among equities and fixed income. Everybody knows we had a very, very low duration in our fixed income book in 2021, and we had a longer duration exposure at the peak of rates not too long ago. So we don't ever get negative feedback. I think the fact that we have the ability to do this, that not a lot of other people can do this, not a lot of people can take advantage of this, I think it's really probably an important selling point of our strategy. It's probably an important reason why people choose to invest with the cap appreciation, because we can do this. In 2022, when cyclicals were on sale, we were buying NVIDIA hand over fist at a very, very low price. And today, when maybe cyclicals are very, very expensive, we're pulling back on cyclicals and adding to maybe more defensive. Right? We have the ability, because we take a longer term view. We're not trying to outperform tomorrow or next hour or next minute. We're trying to outperform the next 5 years. And the market is playing a very, very different game. The market is playing a game that is very, very difficult to win. Having that longer term horizon, thinking beyond the next hour, next minute, next week, allows us the fortitude, it gives us the fortitude to be able to make intelligent investment decisions, whereas the market can be overly impacted by what's happening in the market today.
As you pointed out earlier, there are pockets of opportunity, even with the valuations we're seeing. What are those pockets right now? What are the areas that you find you can lean into in this market?
The areas of the market that are really attractive is kind of these GARPy areas. And just for your listeners, GARP is growth at a reasonable price investing. We believe, roughly speaking, about 13% of the market cap of the S&P 500 is what we would characterize as GARP stocks. Let's call it 75 to 80 stocks in the market that we think is kind of growth at a reasonable price. These are companies that kind of grow organically anywhere from 4 to 7% per year. They tend to have not very volatile earning streams. They tend to grow earnings at, let's call it a 10 to 13% rate every year. And if you think about those 75 or 80 stocks over the last 19 years, their performance is paid out from the market by about 400 basis points per year over that 19-year period of time. And again, with very low earnings volatility. And so both last year and to a certain extent this year, those stocks have really been out of favor because of the AI revolution, because of people want to play a cyclical return in the economy with President Trump coming in. They've kind of fallen by the wayside a little bit. So when we look at the ability to be able to buy these companies at really record low relative valuations, in some cases relative low absolute valuations for some of these companies, we see really good opportunities. That would be anything from like a Becton Dickinson. That would be something like a Yum Brands. These are companies that have very low volatile business models, strong growth, good management teams that should be able to compound wealth at a low to mid-teens kind of rate that have just kind of fallen outside the, it's not something that people are really focused on right now. But again, having a little bit longer time horizon than most market participants, we see, if you compound earnings growth at a low to mid-teens rate and your multiple is low and has more upside, it's very, very hard for the stocks not to re-rate and actually, again, accrue value at, low, mid, or even high teens rate over the next 5 years. So those are kind of companies that we get really excited about. A Revvity, a Becton Dickinson, a Yum Brand. Those are all companies that we think have a lot of upside potential over the next 5 years.
Companies that you don't sound as excited about, but that you have in the portfolio are a number of members of the Mag 7. Now, as you pointed out, you were buying NVIDIA at prices very different from what you're seeing today. But how much does any portfolio, but particularly one of your size, have this, I have to be Mag 7 at least a little bit? And where are you on what the Mag 7 can do going forward?
Sure. First of all, I would tell you, I think we should stop saying the Mag 7. There is no reason Tesla deserves to be in the Mag 7 anymore. A couple of years ago, people thought their earnings power this year is going to be like $25 billion. It's going to be like 5 or 6, right? So, I mean, their earnings estimates, their earnings have basically fallen by 70% over the last 3 years. The multiple on Tesla has gone from like 30 to 150 times. Their robo-taxi strategy is an embarrassment, honestly. So I don't think we should talk. So we don't own Tesla. If Tesla stock fell 90% tomorrow, I would still not buy Tesla stock. Tesla stock does not deserve to be in the Mag 7. So let's talk about the Mag 6. There's a lot of great companies here. And whether you talk about Microsoft, whether you're talking about Amazon, those are two of our favorites in the Mag 7. And those are places where we have big overweights in the Mag 7 or Mag 6. And I got to correct myself there. We do own NVIDIA. We do own Apple. We do own Google. We see, those are still really good companies, but we're going to make sure where do we see the best value in the Mag 7? We see better value in Amazon, Microsoft, but we still see attractive positions, but just not. We don't need to be overweight Apple. We don't need to be overweight NVIDIA necessarily. We don't need to be overweight Meta in the Mag 7. Mag 6. Boy, I keep correcting myself. It is the Mag 6.
Yeah, I'd be happy to change whatever we're calling it to whatever is the next appellation of where leadership's going to be. But speaking of leadership, one of the things that we have seen this year is leadership from international stocks. And you have famously not wanted to get international stocks. In fact, when we spoke at the Morningstar conference back in 2022, your quote directly was, I don't think anyone needs to own international stocks unless you are a non-US investor who needs exposure to currency. I don't think there's any value in owning a lot of international stocks. I don't think you should own emerging markets. I don't think you should own European stocks. I don't think you should own Japanese stocks. That's what you told me in 2022. And your fund has not wavered. You have virtually nothing in non-US assets. But given the performance this year and given where valuations are, there's no feeling that you're missing out, or there's no feeling like I want to make a currency play based on what's been happening with the dollar?
Absolutely not. And I will say, for the record, I think that while it has not worked out this year, it has clearly worked out since 2022 as European, Japanese, Australian stocks underperformed the U.S. indices dramatically in 23 and 24. The reality is, you're just not competing. When we think about the U.S. versus international stocks, even a year where international stocks have done better, clearly, earnings this year for a lot of the international stocks are probably going to be, earnings growth this year is going to be like low to mid single digits. The U.S. this year is going to be double digits. It's going to be basically about 10%, right? So yes, there has been a currency move, but the fundamentals, which is what drives stocks over the long period of time, the fundamentals of international stocks have not improved dramatically. Earnings growth for the international stocks this year, low to mid single digits, actually below what it's actually been the last kind of 5 years. And U.S. stocks close to double digit earnings growth this year in the S&P 500. So I would just caveat that as an important caveat. And when we think about what's in, the U.S., what is in the U.S.? Well, you have the Mag 6. You have a tremendous number of really great companies, carb stocks, great utilities. Internationally, you're just comparing apples to oranges. Internationally, what makes up a European index? There's no Mag 6 stocks in the European index. There's a lot of big, bad, ugly banks. There's a lot of big, ugly insurance companies. There's a lot of big, bad materials companies. There's a lot of energy companies that don't want to be energy companies, right? There's not a lot of great life science tool companies. There's not a lot of great managed care companies. There's not a lot of great utilities. Their industrials are less good than our industrials. And so when people say, well, the European index trades at 15 times and the U.S. market trades at 20 times, you're just comparing apples to oranges. It's just not a fair comparison. So if you have a longer term view and you believe earnings matter over the long period of time, the U.S. market will clearly continue to outperform European markets, international markets. U.S. GDP growth, even though we're having a slowdown this year, is still probably going to be 150 bips faster than that of Germany, France, UK, Italy, Japan, Australia this year. It's just you have a faster growing economy, you have better companies, better indexes. No one listening to this call, to this program, should ever feel a need to own an inferior index just for diversification purposes. The S&P 500, 32% of revenues and earnings today come from non-U.S. sources. You do not need to buy an inferior index just to somehow justify to yourself or your advisor that you should own international stocks. What is going on this year is an anomaly, nothing that I think will persist on a long-term basis.
In terms of what does persist, obviously your performance has been great, as I've laid out for folks, but it's been exceptionally good at times when the market has gotten rocky. When everyone else is suffering, it's not that you haven't suffered with them, it's that you've suffered a lot less. So I need to know, we entered the year with people thinking there'd be some sort of a landing. We went through a period where everybody thought there'd be some sort of recession. Nobody thinks we're getting recession now. Nobody's looking at this stuff. Are you worried that trouble is coming? And how much are you preparing for what you think will arrive?
It's a great question. I would tell you 99% of what I do on a daily basis, if you think about what I've been doing today since 7 a.m. And what I did last night, I spend my time on the micro. I spend my time getting to know Becton Dickinson, Yum Brands, Danaher, NVIDIA, as well as anybody else in the market does. That is what I spend time on. I don't have a view what the economy is going to do next year because I don't have a competitive advantage there. I just don't have a competitive advantage. What I can tell you is, though, when equity markets get rich, when people get optimistic, that's when you should be scared, right? Because we know forward equity returns tend to be subpar in that period of time on a 3 to 5 year view. And when there's blood in the streets, when people are getting scared, when VIX is spiking, when bank CEOs are calling for recessions, that's kind of counterintuitively when forward equity returns are higher. So I don't have a prediction on the economy. That's not something that I spend a lot of time on, honestly, as I don't have an edge there. But what I would tell you is high valuations, positive sentiment, that's usually not a great time for forward equity returns on a 3 to 5 year basis. Doesn't mean equity just can't be fine, but just historically speaking, that's not a time to be really diving in aggressively to equities.
Well, David, I have dived in as aggressively as I'm allowed to in this interview from a timing standpoint. I feel like we just started and yet we're out of time and we've extended as much as possible. So I hope you will come back and talk with me again soon. But thank you so much for joining me today.
It's always a pleasure. I'm always happy to be back. Thank you for the really thoughtful questions, and I really enjoyed the conversation.
That's David Giroux. He is the manager of T. Rowe Price Capital Appreciation. He is Chief Investment Officer at T. Rowe Price Investment Management. Yes, T. Rowe Price Capital Appreciation is in my portfolio and is one of my largest holdings. I have to disclose that because I've been talking about the fund and saying good things about it. But if you want to find out whatever you want to look at about it, troweprice.com is where you go. Hey, we'll come back. We'll let you know what's coming on the rest of this week, including FinCon, right after this message. Stick around to the end.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Wow. I just don't have much to say. I mean, come on. If that interview with David Giroux didn't convince you that maybe, there are times when you want active management, then you are distinctly a diehard indexer like you. He's making the case for what he can do and what can go on and how he's going to do it. And again, I'm a shareholder in the fund, though it's not like if you were to buy the fund tomorrow, you would benefit me in any way, because you wouldn't. But I have to disclose it. I will simply say, go back. If you liked that interview, go back and listen to Todd Rosenbluth from the ETF of the Week a couple of weeks ago when he made the ETF version of T. Rowe Price Capital Appreciation his ETF of the Week, and say, okay, let me hear the reasons why someone else independent says you might buy this fund, and then compare that to what you just heard David Giroux say and go, would I want this guy managing money? You have to have the conviction to ride through. And it's hard to listen to David Giroux and not go, I've got, you've convinced me. I'll ride with you. And again, it's remarkable. There have been countless stories of managers who have made a change and then they've been wrong. They've come up on the wrong side of the numbers, at least for a while. And their audience went to get rid of them, like Fidelity Magellan being perhaps the most famous case. But guys like John Neff, when he was running Vanguard Windsor, he was early a number of times. And he used to say that if he had done it in a more modern time, he couldn't have done it. Yeah, you could see why just deviating to where you are no longer just a pure stock fund and you're now a moderate allocation fund. But again, he might not be that if the market changes and he wants to do all really interesting stuff. So I hope you enjoyed that interview as much as I did. But let me know if you think I'm nuts, and that was a terrible interview. Tell me. And I know that occasionally people say, oh, you let him off the hook. You didn't say, go give me a bunch of stock tips. But he dropped a few names in there. So I think you got a sense. Tomorrow, Jeff Patak, Managing Director of Morningstar Research Services, will be here. We're going off the news on a story he did about popular funds and how they're popular, they get money, and then they disappoint, but not in all the classic ways. Allison Hadley from Digital Third Coast will be here talking about a survey she did that looked at mid-year tariff emotions. And Conrad Dunges, Chief Investment Officer for Ranger Investment Management, will be here. I will be transporting myself, from Raleigh, where my kids are, where I'm visiting, to Portland for FinCon. So everything you're hearing now was done in advance, but tomorrow you'll get me with the first live reaction. You hear me having met my grandchild and things along those lines. Meanwhile, if you are looking for something to celebrate today, it's Star Trek Day.
Live long and prosper.
Yeah, well, the television series pilot known as Star Trek started its life on September the 8th, 1966. So that's why today is Star Trek Day. It is also National Pediatric Hematology Oncology Nurses Day. Those folks are saints. And National Boss Employee Exchange Day. Yeah, I never thought that was such a great idea. My guests today were Natalia Brown, Chief Consumer Affairs and Creditor Relations Officer for National Debt Relief, nationaldebtrelief.com. David Traynor from New Constructs, online at newconstructs.com. And David Giroux from T. Rowe Price Capital Appreciation, troweprice.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Carly Garner from DeCarly Trading, and she said it on the show on August the 5th. She said, when things are tight in people's pocketbooks, the first thing they stop doing is speculating. Well, we know things have been getting tighter. You want to keep good control and perspective on your money. Whether it's speculating or doing anything else, keep in mind that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll be back with you tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Let's just hope nothing like this ever happens again. Probably won't. Not for another year. Check that. Couple days.